Alex Pollak, good afternoon. Alex, for our viewers, is the CIO of Loftus Peak Global Disruption Fund. The fund has a 5.5-year track record and invests in global markets, but you shouldn't be listening to me about that. Let's talk directly to Alex and see how he's finding these extraordinary times. Alex, the first question is, did you ever imagine, having lived through 1987 and 2008, that we'd be seeing markets quite as disruptive as they are now?
Well, it was always out there. You know, that there was the debt bomb floating around from QE, etc. That bomb's still floating around. I think it's safe to say that, well, there's always been a correction in my head at some point in the future. I wondered whether it was a planetary connection. In fact, it's turned out to be a biohazard correction. So we are where we are.
And talking of where we are, how's the fund performed over the last few months? I mean, I think it doesn't really matter in many investors' minds how the fund might have travelled up until December or January. It's what's happening now, because everything's really been thrown on its head. Global Disruption Fund sounds as if it should be going well. How's it going?
Look, it is going well. We have, from the outset of this fund almost 6 years ago now, we always had set it up to invest in, well-established, large capitalisation companies that had disrupted existing business. And so our portfolio is, comprised of companies like that. Apple, of course, is one. Google's another, but then there's also Tencent and Alibaba and a stack of others. These, the median market capitalisation of the companies we hold in the fund is over $79 billion US. So it was always based on this idea that we wanted to provide a lot of safety around the disruption theme. We knew that disruption was happening, but we didn't want to be in small companies. We wanted to be in companies that were the best position to actually take advantage of it. And that's actually worked really well for us, especially in this last few months. We, in this market, are only down just over 3% since the 31st of December, and we are very significantly outperforming the benchmark index that we use as well as pretty much everything else right now.
And one of the core themes, as I understand it, is that you invest in companies with either very little debt or no debt at all, and with significant cash flows. Now, I would suspect, looking at around the globe at the moment, that those companies are exactly where you want to be. My own personal view is there's going to be a debt crisis at household and at company level as earnings absolutely plummet. And if companies and households, if it comes to that, don't have a strong balance sheet, they're going to be in all sorts of trouble.
Yeah, I mean, that's our read as well. The first wave of this was actually just, a sell-off, and that's taken place. The second wave is where we are right now, and that second wave is equity markets saying if a company had not yet reached cash break even, still had a slightly unproven model, or for any reason it was likely to need to come to the market, either the debt or the equity market, in the next 12 to 18 months, those companies are being sold down another leg on top of the actual market fall. And so now we are seeing this real winnowing out of those players those companies that did not quite have all their ducks in a row in terms of their cash flow working properly, their profitability working properly. And even if they've got those things working properly, but they still needed more debt and equity, the market is saying that, debt and equity markets are closed for the time being. That is the issue. Those are the companies, frankly, that we have pretty much entirely avoided, where we have taken very small positions in those companies that they've been less than 1%, because we've always had the view that the refinancing was an issue. And so we've adjusted our risk, or we've adjusted our exposure to these companies through the choke of the position size. We've kept a couple of them at small sizes So, you know, if they don't go well, that doesn't really bother the overall performance of the fund. You know, that was certainly the case and still is the case. We, you know, as you know, we were up 35% the year to December 31 and only down 3.5% since then.
Alex, well done. We've used up our 5 minutes of time. I promised you it wouldn't take more than 5 minutes, so thank you very much. You need to get
Chris.
back to markets.
Yep.
We'll keep everyone updated via the Fund Monitor's website and your profile, and good luck with it. I think these are testing times, but thank you for your time this afternoon.
Thanks, Chris.
Okay.
Thank you.